Oh, I had my mic muted. Hello everyone, I'm your boss, Joe Boss. Sorry about the mic mute. Let's go ahead and get into things. So, we had a big day with FOMC and all the other central banks that came along and said all sorts of different things. I kept note of what was coming down the squawk here in the Central Banks channel. You can check it out in the link in the description. That is the discord.joeboss.com link. And you can see here, we go ahead and just follow in real time as updates are coming out of the FOMC. This was before the press conference. So we got to see the SEP, we got to see what they decided to do. And then I went ahead and looked over what was going on, as well as looked at what other people were saying over on X, other heads of research of different institutions, of different banks. And they were all looking at the exact same thing. But what was interesting is that they were coming to different conclusions. So once the next day or much later on in the day came around, a few of these banks started to give their insight. And you can see we had them forwarded from the Outlooks channel here, from the Mr. Outlooks app here. And I just found this totally hilarious. I went ahead and I sent this to a bunch of people in my DMs on X and in the trading group. Again, link to that's in the description, but stick around. If you're interested in the trading group, stick around for a bit on the stream. I got something for you. When we were looking at... music's just a bit loud for me, so I'm going to turn it down a little bit. A little distracting. Sorry about that. But no, genuinely, what was really funny about these reports, and probably you can tell just by reading them right off the bat, if I zoom in a little bit. So here's one institution saying, we expect 2 rate hikes. And then here's another institution saying, we expect 2 rate cuts. Isn't that just kind of insane? The amount of people I hear saying, oh, the Fed is hawkish, I think have maybe what I would call Powell syndrome. They still, for some reason, think that Powell is the person in charge of the Fed and not Warsh anymore. And just because Warsh didn't say anything explicitly hawkish or dovish, that the rate decision and the press conference answers that he gave somehow imply that everything is much more hawkish. And then we have a few more guys here saying, hey, markets read this as hawkish. I will say that much is true. Markets have indeed read the FOMC meeting as hawkish. The dollar got stronger. Yield spreads moved against all the other FX pairs. It was indeed a hawkish market reaction. But I would argue to say that this might be a quote-unquote legacy reaction. And by legacy reaction, I simply mean I think these guys have Powell syndrome. And maybe I should explain that. Simply put, the people who are taking this explicitly hawkish expectation of the Fed are over-interpreting what Warsh is saying. For all intents and purposes, Warsh is keeping the Fed on hold. He has these new task forces, and these task forces are going to look at all the different metrics of the FOMC, and they are going to review the efficacy, how quickly they get this information, going to update what surveys are used. They're going to revamp the economic data pipeline that goes into the Fed's decisions. And that's one of the reasons why he's also stepping away from monetary policy guidance, from forward guidance. Because as you start making those changes, you don't want to start setting expectations for the markets that if those expectations come in opposite based on the task force's results of what you expect as Warsh's position right now as the Fed chair, then you can end up in a really dangerous position where markets are reacting completely against you. So more institutions are interpreting this as explicitly hawkish and expecting 2 hikes, and then there's a couple expecting 2 cuts. I personally like Unicredit's take here. And a couple of the people who I talked to in DMs about this explicitly are in agreement with me that the explicitly hawkish future expectations are an overinterpretation. For example, a lot of the FOMC pricing right now, for some reason, is going as far as to expect a rate hike by September. Excuse me. But I think that is really overreading the new information. Because out of all the outlooks and all the research I've read so far, and all of the commentary from all the different experts I've seen, I do not see a clear reason why anyone would explicitly expect, oh, they're going to be hiking not at the next meeting, but at the following meeting. It doesn't make sense, at least to me, based on explicitly what Warsh said. So I find that there are some market participants that are getting ahead of expectations, that are doing over-interpretation, that are overly extrapolating, for example, what those task forces might be delivering on, and are making much more hawkish calls for the Fed's policy rate than is actually justified. So the reason why I appreciate Unicredit's outlook here is because, and there are a few institutions also expecting something similar, which is, hey, we expect the Fed to essentially stay on hold. And I can read Unicredit's thing here. The market reaction at the short end appears overdone. Now, specifically what the short end means is, for example, 2-year yields, 2-year US yields, moving really high. We can go ahead and pull up 2-year US yields right here. And I believe FOMC was around here, right? Yeah. All right. The market reaction on the short end appears overdone. It reflects a framework rooted in the past, Powell syndrome, rather than what lies ahead. Warsh downplayed the dot plot, did not submit his own forecast, and pointed out that FOMC members do not have great confidence in their forecasts. Again, SEP forecasts change wildly from one SEP to the next. A survey of economic projections is the report that the Fed releases, I believe, on a quarterly basis. And man, you know, whenever the dots changed under Powell, that essentially was law. And to be frank, that did make trading dot plots really explicit, because that was just the Fed saying, hey, here's what you're going to do, market. Here's how we want you to set it. And unless they were doing something really explicitly poor, like, for example, back during COVID, talking about transitory inflation, oh, this inflation is transitory, then we ended up with all the people expecting rate hikes getting to make a lot of money, taking advantage of the Fed, then having to catch up later. All right. And then guess what? That's also given the high level of uncertainty. And that uncertainty is very material and quantitative. Just look at these two posts right here from Danske Bank and CIBC. 2 hikes versus 2 cuts. Don't get me wrong, it's probably a 70-30 split of people expecting hikes to cuts by the end of this year. 2 hikes versus 2 cuts. I mean, there's very few people expecting 2 cuts, right? But let's continue. Now we are penciling in a prolonged period of unchanged rates for 2 reasons. First, Warsh's inflation rhetoric was more hawkish than we had expected. Second, the FOMC will have little incentive to move while it waits for the committees to deliver their inputs on critical topics. Those are the task forces. That will affect both the way the Fed reads the economy and how it reacts to macro developments. Unless the growth and inflation outlook shifts materially, the most sensible thing for the Fed is to wait and see the remainder of the year, after which visibility regarding the future path rate will hopefully increase. That was my initial expectation when I was listening to the press conference, and frankly, even before listening to things that Warsh was talking about. I was talking to a friend about his, who was listening to his Hoover Institution analysis, his Hoover Institution discussions that occurred over the last couple of years. And, I watch a decent amount of the Hoover Institution's stuff. So I was like, I'll go ahead and look around and see what I can find. And so I remembered to familiarize myself with what his views were going into the event. And it makes sense. Like, oh, he might want to change what the underlying measures are that the Central Bank of the United States of America uses. Not necessarily to evoke rate cuts for political reasons because of Trump, but simply for efficacy reasons, to improve the speed at which the FOMC is receiving information, to reduce the lag. Changes in monetary policy are variable and lagged. And the more control you have over those lags, the better you can maintain the central bank's credibility, honestly. If you start seeing a lot of high inflation data come in, you want to know that that is good data, right? And that was the issue of Powell and his transitory theory, which was, oh, this will just go away. But I bet if they were looking at more data, like all the rest of the institutions, they would have come to the same conclusion. The Fed, Powell, during that time, would have come to the same conclusion as most of those institutions did, that the inflation was not transitory. So there are clear quantitative issues to improve the measures and the benchmarks for inflation and growth, etc., that the Fed is using to make monetary policy decisions. And via that improvement, can themselves start to make, you could say, more apt, more timely monetary policy decisions. Which is really, really good. So across the board, and I agree, markets think that this was a hawkish meeting. But I'm going to hold my breath on explicitly saying that this is hawkish because we now need to see what the new measures are going to be from these task forces. Because what if these task forces come out with something that sets the bar higher or lower for changes in the cash rate at the FOMC? Well, then you're going to have to either get more hawkish or more bearish, more dovish. And I think setting expectations for 2 rate hikes or 2 rate cuts, like some of these institutions I just demonstrated have done, is genuinely getting ahead of the expectations. Let the task forces do their thing, and then we will come to a reasonable conclusion about what to expect as the, again, watches it into forward guidance. But what the market thinks the forward guidance of the Fed will be, what the future expectations will be for the Fed. All right, so given all that, and that was the major thing I wanted to cover, a lot of these outlooks actually have covered something that I've built an indicator for that people in the trading group have access to. It's $100 a month, but if you stick around for a little bit, there'll be something special here for you. So if we go to, let's try euro dollar. Because when we saw the dollar rise after the FOMC decision, the currency that has got the highest weight to represent the DXY here, which is the dollar index, is the euro dollar. And you can see the euro dollar is kind of like the inverse of the DXY. Now, my bars are colored a little differently. If we go back to DXY, you can see this is regular green and red bars. But as soon as we're on euro dollar, the bars are colored a little bit differently. They're not colored based off this trend line here. That goes red and green depending on the trend. And this is actually a standard moving average. And this is actually a free indicator. You can get access to this directly through my TradingView account. This is what I'm talking about. This is the FX yield spread curve. And across multiple outlooks from multiple institutions, you know what their number one reason was for staying long the US dollar is? The spread between 2-year yields between 2 different countries. So you look at the United States and its 2-year yield. And in this case, because we're looking at the euro against the US, we then compare the US 2-year yield against the European 2-year yield and check the differential. That differential is right here at this 2-year spot right right here. But the difference with this indicator is it doesn't just do the 2-year. It does the entire gamut of durations. So we're able to check in real time how yield spreads are moving from one day to the next, or even intraday. So you can go to a 4-hour and check how the yield spreads are moving. And you can even see the yield spreads are recovering a little bit here into the end of the week. Now, my expectation, given the current state of the yield spreads and what I think is going on with the Fed, is that yield spreads will stay negative-ish for about another week or so. And then once we get into July, closer to the next FOMC meeting, before the blackout, we'll get some commentary from other FOMC members. They'll discuss that they will try and stay essentially on hold. There will be no forward guidance, but we will know, I hope, what those new measures will be from the task forces at the FOMC. And it's still really a coin flip in my mind. I have high uncertainty as to how markets are going to react to the announcement of the results from those task forces. Will the dollar increase in valuation from those task force results being announced at the next FOMC meeting? Or will the dollar fall? That's the main question that I'm working with right now and trying to think about. What's the game theory there? What are the possible outcomes that could be occurring? So I'm looking for that type of analysis at the moment. And the reason why that's important to look for that type of analysis is explicitly because if we have a better idea of the distribution of how those task force results will come out, we'll have a better idea of if the dollar will be strengthening or weakening or be staying about the same. So, I hope that makes sense. And the reason why I'm going to now just move on here is because I would like to focus on these yield spreads here. These yield spreads are still incredibly negative. They've been a better momentum indicator for me than most other momentum indicators. But the way you read this indicator is in one technically of 3 different ways. You can just look at the bar colors here. And the bar color is the aggregate yield spread, which is actually this most bottom right number here in this table. It just takes that number and colors the bars of the chart based off of it. So you can hide the whole thing. You don't need to get into the nitty gritty and just be like, oh, yield spreads are negative right now. I guess the bias is in favor of the dollar strengthening when yield spreads are that negative. Sure. But if you want to see the progression or the change in the yield spreads over time at a more granular level, what you can do is look at things duration by duration. Because that's what these are here. This 1 year, 2 year, 3 year, 5 year, 7, 10, 20, 30. These are all bond durations. So when the bond durations are incredibly negative just across the board, that's pretty indicative that, okay, yield spreads are in favor of the dollar. And if all of these yield spreads on this table and displayed here through these bars were green, then that would be wildly in favor of euro. Which is why it's important sometimes, not just to get the aggregate. If only the front side of the yield spreads are moving, markets can be really reactive to it. And the front side just means the shorter duration yield spreads here, the 1, the 2, the 3. And markets can react more structurally. The regimes can change if you see the longer term durations move more positively. So if you see like what we have right now with the longer duration yields move more positively, it's setting more positive future expectations, longer term expectations for the euro. So I'm hesitant right now to take incredibly strong dollar short positions, even if in the short term it actually could be very, very profitable. I made a stream and a video recently actually on the dollar smile. And I said in those videos that we are pretty clearly on the right side of that smile, where the US dollar is performing better than all these other currencies, because the United States of America is performing better than the rest of the world. So when the rest of the world is not growing as much, the GDP is lower than the United States, inflation is higher than in the United States, then what you end up with is a regime where you're on the right side of the dollar smile. I'm sorry I'm not going to be able to go into too much. Oh, I just hit my chair. The little lever on my chair that makes my seat go down with my leg. Oh man, now I think I've lost my train of thought, but hello, Adi. Nice to see you. So, not a problem. I know it's very late for you. I'm so happy you could make it. But if you're interested in this indicator, and you're interested in me walking you through it some more, because yields, I could start pulling up outlooks, right? I could start pulling up the walls of text. Actually, I got something that's a little easier. There's a channel called FX Yield Spreads, and it's literally just quotes of when institutions have said, hey, the yield spreads are why we expect, the primary reason why we expect a currency to go up or down. It's just a whole channel full of quotes. Oh, yield spreads are super positive. Oh, I guess we're going to be going long. Oh, yield spreads are negative. Oh, I guess we're going to be going short. The second reason why we don't expect euro to strengthen much against the US dollar is that yield spreads between the eurozone and the US remain supportive for a stronger US dollar. Almost every single week, I get an institutional outlook talking about FX yield spreads. What retail trader has an FX yield spreads indicator on their chart? I don't know. So if you're interested in this indicator, I'm going to go ahead and do something here for you guys right now. If you go here and use that code, you go to my WAP, the Boss Trading. You can go ahead and get this for, I believe it's 20% off. Now, if you've already been subscribed, if you've ever been subscribed before, I believe there's going to be another bonus for you if you were once subscribed before, actually. Because you'll be able to see a bunch of new stuff. Like all the group notes stuff, we have some new group notes. Again, the trading group, the trade logs, all sorts of good stuff. And then, of course, you get access to every single indicator when you get into the trading group. It's really good stuff. Come by, join the group. Come by, check this stuff out. Again, I'm doing stuff that's very orthogonal, unique compared to most other discretionary traders out there. Simply due to the amount of research that's being done in that Discord on geopolitics, on elections, on wars, staying up to date with X accounts of heads of state and heads of research from all these different groups. We're able to find where these people get their information from and try and stay on top of what they're reading, and then build our own pipeline to gather that information for ourselves, so then we're not dependent on that analysis anymore. That's what I mean by trying to build things that are orthogonal to what we're already doing. And yield spreads are very orthogonal. Very, let's try yield spreads. There's literally one indicator publicly available, and it doesn't even do what my indicator does. Yeah. So, I mean, genuinely speaking, there's a couple of guys in the trading group who are just subscribed for this one. And there's a lot of people just subscribed for the probability pivots. There's a lot of people just subscribed for the range probabilities. So if you're interested and you want to try it out, try it out. We can go ahead and start doing some week ahead trade plans. So this is very likely, I think, the low for the month on Eurodollar. We have never in the history of Eurodollar, for maybe about the last 20 or so odd years, gone during the month of June below this pivot point, this S2.5 pivot. Now, we very easily could continue to move below this pivot if yield spreads continue to move more negatively. And that would match up with the expectation of market participants expecting the FOMC to hike in September. But I seriously doubt that expectation. I seriously doubt the Fed will hike in September. Given that Trump also still has a form of soft power over the Fed and will try and pressure Warsh into it. I think so long Warsh just takes his time and stays on hold, Trump's not going to be upset. Markets are going to think that the Fed's making a policy error. And if inflation comes down over the rest of the third quarter here into the fourth quarter of the year, then it would even be justifiable for a cut. I genuinely am in the Cathie Wood camp at the moment. If you're familiar with her analysis in the last month at all, she expects growth around the world to increase and rebound. She expects inflation to fall, and for things just to generally be very risk on. And that has me particularly focused here on looking at an opportunity for us to move from the right side of the dollar smile. The dollar smile looks like that. On this side of the dollar smile, you are seeing the dollar appreciate. And on this side of the dollar smile, the dollar also appreciates. But it's at the bottom, the middle of the smile, where the dollar devalues. And that regime at the bottom of the smile is described by other countries experiencing higher growth and lower inflation at a pace better than the United States. And I think maybe not in the next immediate months here, but maybe even going into Q4 and especially into 2027 for that setup's likely to occur. Now, this is deja vu for me because we thought this was going to happen back in January of 2026 here. So I am perfectly able, willing and ready, willing and ready to change my mind on that expectation if the data never materializes. It is very easy right now to just expect the dollar to stay strong, for equity markets to continue doing what they're doing. And then as the recovery from the Iran war begins to progress, as the rest of the world begins to recover, as more trade deals are done, for this opportunity for the dollar to weaken to occur. So I have my eye set on it, and I am looking towards it because it's a theme that I've been almost waiting on the entire year. That was kind of the expectation going into the Iran war, but then guess what? Dollar just kept getting stronger and stronger because the rest of the world kept underperforming the United States. It was kind of crazy. So I think maybe going into the end of the month, we'll see some kind of bounce. That would be my nominal expectation. But it's not going to be a very big one. Maybe it's like 50-ish pips or whatnot. I don't expect a whole lot for Eurodollar going into the end of the month. But I do see there is risk of us even going lower. This is another indicator you get access to when you're in the trading group, called the timing dots. Now, all these little red dots and blue lines indicate where prior lows have occurred, given the high for the month. And then looking all the way back to the beginning of the chart's history and finding highs that were similar for the month. And then plotting those. So this is saying, hey, you can go pretty low when the top for the month is up here. Excuse me. So do I expect there to be, a total collapse to like 113? It's like, well, no. There's a chance. But I don't want to bet the house on it. I don't want to bet the farm on it, right? That doesn't make a whole lot of sense. So I'm going to nominally expect just a little bit of a rebound that looks something along these lines here. And we can color it blue, right? A more nominal rebound to like the 115.5 spot. But if yield spreads continue to significantly deteriorate, maybe there's something so explicitly hawkish that comes out of the mouths of the other FOMC members, right? Or maybe inflation jumps a whole percentage point, right? Something ridiculous. Or the war with Iran restarts. Maybe the memorandum of understanding gets canceled. Yeah, that's what would send you lower. That MOU getting canceled, yeah, that would be it. But currently the MOU is signed. The Iranians don't want to see more of their leaders killed. They don't want to see more bombs their way. I genuinely find it funny when people say like, oh, the Iranians have won they're getting the upper hand. I don't know if you know this, but if you've ever seen the Iranian leadership organizational chart, about out of the 30 or so people that they put in this org chart, they have to cross out with red lines and put killed in, right under their name, right under their profile. Unless Iran wants another wave of that, I think they'll try and work with this MOU. So, if the U.S. really doesn't want to do something, they won't do it. And there's no reason to expect that the U.S. will capitulate on anything that's insanely unpopular with the voter base in the United States. Given their military superiority in the area, because even though it's gone, they can just put it back in. Just because it's gone doesn't mean it's gone forever. And two, the midterms, the U.S. midterms are right around the corners, guys. If, you could take the rumors of like the $300 billion. Oh, the $300 billion is going to be sent to Iran, even though that's actually just a promise of investment by other Middle Eastern countries and U.S. corporations over the next however long after the peace agreement is officially signed. Let's just say, the U.S. government's going to give the Iranian government $300 billion, and it's not actually this other thing going on. Well, you know how wildly unpopular that would be during the midterms? Like, that would be explicit sabotage. So that's not actually what's happening. You got to be very, very careful reading news and the media, which is why when I'm looking at the Discord and I'm looking over all these research threads, primary sources, please. Like, it's all well and good to get sources from like this, that, or the other guy or some random dude on Telegram. It's all well and good, but get primary sources. Like, for example, when the president of Pakistan announced the peace deal, you could have posted the Reuters article, the Bloomberg article, the article from pick your favorite news organization, whatever. What I want is the damn link to the official announcement. I'm all well and good for getting the articles if that's fine. That's totally acceptable, especially if they include additional commentary from such and such experts that they have on payroll to comment on such things. But I want the primary source. We're not Wikipedia here, right? Wikipedia will they don't do primary sources. They explicitly want, tertiary sources, essentially. They want to play you want to play a game of telephone with Wikipedia and get your source from a source from a source. No, I want to hear directly from the person who's in charge exactly what he's saying, and then I will consider what other people are interpreting, right? If other people have these insane biases, I don't want to listen to the source of the information I'm trying to trade around from these other sources. I want to listen to the information, and I want to make my best unbiased decision around it. Now, I do have my biases, but I try and do my best to acknowledge what those are and come up with my biased view and my unbiased view. And because I can relate to people from other political likenesses and philosophical likenesses, I can say, well, here's what someone more pessimistic might say. Here's what someone who's super conservative might say. Here's what someone who's more progressive might say. Here's what someone who's more optimistic might say. And I'm smart enough where I can relate to those views. And it's a skill that can be simply built up by going through different types of scenario analysis and playing that game. Like, think about what you would believe if you were an optimist or a pessimist and you read this sort of information, right? And then once you go through that exercise and then you start reading outlooks that come down the pipe here in the Outlooks channel from all these different professional institutions, guess what? It becomes a little easier to anticipate exactly what they're going to say. It's kind of nutty, especially if you read the regular writers of these outlooks. So if there's a handful of guys who write a couple of these outlooks and they say something along the lines of like, you can clearly tell their style of writing. You can clearly tell that they are more optimistic. You can clearly tell they're more pessimistic. You can clearly tell they're more conservative. You can clearly tell they're more progressive, right? In the example I gave before, then you'll be able to anticipate what they're saying much more easily when you run through those exercises a few times and familiarize yourself with the different philosophies of those different biases, as well as maybe doing a little bit of watching YouTube on like, okay, how do biases actually work in psychology, right? How does a bias form? That sort of stuff. It's not complicated. It doesn't take a long time to figure out, and you don't even have to be particularly smart to learn that. It's literally a Google search and being aware of the information so then you can actually learn it. That's literally the minimum bar to actually learn that stuff, and maybe speaking English, because a lot of the content's in English, right? But given all that, it's very, very important not to, from those outlooks, from that research or those second and tertiary sourced news articles, come to explicitly hard-line beliefs about what to expect in the future. Your future expectations always need to be a distribution of outcomes. They can't just be a fixed point. Because once they are a fixed point, you're really screwed if they even come a little to the left or a little to the right of that point, right? That's why you want to understand the distribution of outcomes. The distribution of future expectations. And trading, fundamentally, is about getting exposure to future expectations. If you think this asset, euro dollar, is going to go up in the next few days, you have a future expectation that the euro dollar will go up. Well, now what information are you accounting into that? If you have the expectation that actually euro dollar will go down, well, now what other information are you accounting into that? Now, let's not have short-term memory loss here. You saw what I was doing, right? I said my nominal expectation is for this line here to realize itself, to see a little bit of a bounce, maybe like 40 to 60 pips higher, right? And then I clearly acknowledged, hey, if the yield spreads continue to get negative, I would expect us maybe to trade closer to where these red timing dots are taking us. Things become more explicitly straightforward. Now, where do I come up with the nominal expectation for this? Well, that can come from range probabilities. And you can see it's more like, hey, maybe we can come a little bit higher, maybe a little bit lower. It's just a reversion to the highest probability density spot of where we end up closing for the month. Or if you wanted to use more seasonal data, we can go ahead and load the closing probabilities here. And you can see most of our closes would even say, hey, you want to probably put this expectation a bit higher unless you expect us to close way down here, right? Like expect a stronger rebound, Joe. So that's what I would say by nominal expectations. What is the highest probability? What is the average, median, even expectation given the current data? All right. I know I didn't cover a whole lot here as far as looking at different charts and going down equities and commodities and crypto and other FX. But I think I've certainly covered a lot of ground based off of the way I like to cover analysis, some of the tools that I use. And I implore you to join the trading group. Go ahead and use that code. Get a nice little discount for yourself. And it's already a free 14-day trial for it. So I'll say thank you guys very, very much for watching. I look forward to seeing you guys at the stream next Friday. We do these streams every Friday. And then there's always, keep notifications on. You like and subscribe and all that, but keep the notifications on. Because sometimes when things go down, like when the peace agreement happened, I do an impromptu stream. I will just stream right then, right there, and give my thoughts on it as soon as it's going down. So keep the notifications on for those impromptu streams throughout the week when things are happening. Sometimes a couple of weeks go by, I just do my Friday streams, all good. I focus on expectations for the week ahead. But if you want to dive deep with me on exactly what to look at, chart by chart, asset by asset, go ahead and hop into the trading group for this week. Otherwise, I'll see you guys next week, all right? So I've been your boss, Joe Boss, and I will see you guys in a bit.